Morning, morning everyone. Hi, lots of familiar faces I can see. So happy to see you, Sarah. You're looking great as usual. How's everyone on a Sunday? Yeah, good, good. Yeah, we're gonna the session I'm gonna take you through. Okay, probably need you to have a bit more brain power on, so you guys need to be switched on. A strong coffee, if you guys do need that, please go grab one. Because we are going to dive into the nitty gritties. I will have my investor's hat on as well as my accountant's hat, and see if we can dive down into a little bit because as you know, most of the time I'm a driver, but from the accounting side, I'm a very analytical person as well. So when it comes to what we call it stop the bleed, or what I would like to rephrase it a little bit, supercharge our portfolio, right? Okay, so because as an educated investor, you shouldn't be bleeding as hard as the majority of the public. Okay, so let's just put it that way. So I would like to be a bit more positive and say, look, how we can supercharge our portfolio and move forward from there. Right, well, I'm just going to share my screen. Can people just type into the chat box, because I can't see your face all the time, anyone has holds a property or currently owns a property or has a property portfolio? Can we type that into the chat box, please? I just need to make sure that I can see. Yes. Okay, so majority, right? Awesome. Okay, can you guys see my screen? Yes, okay, so that is my PowerPoint working, good. Right, okay, so for the people that have already owned properties in their portfolios or rental properties or trading properties, this session will be especially very good for you. Hopefully you guys can take away some action points that you guys can work on as soon as starting from maybe end of today's session or from tomorrow. For the people that don't have any properties in your portfolio, there are still some actionable points where you guys can take away from the session. So please have your pens or paper, or just like type notes as you go. So let me see. I just need to move the comments away so I can see. Right. The very first thing we need to do is we need to do a portfolio review. Okay, people who has properties, can you please have in the chat box, when was the last time you've done your portfolio review? If I come to you today, or if you're sitting in front of a broker and say, give me your current snapshot, do you have that readily to go? Yes, right. Okay, so it is very important that we stay on top of changes and staying on top of our own portfolio, okay, because this is our asset. People say, okay, we do an annual review or we update our portfolio analysis on an annual basis, but as an accountant or as a investor, that you need to be a bit more proactive, okay. Even better, your information should be updated on a rolling basis. What does that mean? Okay, so you have a snapshot of your portfolio, right? The interest rate is coming up for renewal next month, or as soon as it's got renewed, your spreadsheet is updated. Okay, so in that point, you always are staying on top of what your portfolio should be like at this current snapshot. The good thing is about that is when you go out and talk to your power team, you always have that information readily available. Okay, I have a lot of clients come to me sitting in front of me in my accounting firm. I say, yes, prep your information and bring it in and see me and we'll go over it. And they still give me some estimate numbers or sort of numbers. Okay, so these are not good enough. Okay, when you have these numbers readily available, you should know these numbers down to the cent, or you can pluck these information out down to the cent. Right? There's no good sitting in front of the accountant or the broker and says, I roughly earned 100K. No, you need to tell me how much before tax, how much after tax. You should know that. You should have your payslip. If you don't know, bring in your payslip. right? Okay, so when it's not at the big picture level anymore. So when you go and talk to your A team, your broker, your accountant, the information needs to be exact. Okay, I'm going down to I'm being very picky now. Okay, so I'm not talking about the big levels. So first thing we need to show, if you have a portfolio, buy and hold, you need to know your cash flow. Down to the cent, you can't say, okay, so we're not working on the basic formulas anymore. 10% of the MOE, that's not good enough. What's your actual MOE, right? Your insurance, 10% of your rent, that does not cut the line anymore. What is your actual insurance? Okay, so you need to do a very, very proper cash flow analysis on your portfolio. That's number one. Okay, based on that information, you can see the strengths and weaknesses of each property, right? What is this property giving you? So each property, when you look at those numbers, each number would give you a story, okay? Is it a basic rental or is it a cash flow cow because I'm renting it a little bit differently? Is the MOE very high? Did I buy the property in the region, so the rates are killing me, or the regional rates, okay, is very high? Or am I buying in Auckland, whereas the rent is not very good, but the rate is so-so because we have a bigger council to take care of that. So you need to dwell down to each number of what it is. Okay. The current value of each property. Okay, that is very important too. Okay, constantly updating yourself with property or on the market information. Your value 3 months ago will be different to now. And that is just like keeping in touch with your power team or just keeping yourself up to date with what's happening in the market. By knowing the current value of your property, what does that tell us? That kind of gives us we know what our opportunity cost is, right? Or if I sell that property, what kind of cash or what sort of money can we recoup and go again? So if your property has gone up from 200K to $1 million, your return on investment on that amount of money would have changed. Can you sell it for that $1 million and come back and use that $1 million and do something else? Or should you just leave it because you can't buy a property at 200K anymore? Okay, so you guys need to know these figures before you can make any decisions. So when we do a current snapshot of our portfolio, we need to know a lot of things. The current LVR and available equity, you need to work that out. Okay, so that will come down to your current value of the property. Do you have any non-working capitals or equity sitting in there that you are not utilizing? You do not know that until you go and find it out. That was a very personal experience of mine. I went in and bought, I think, 5 properties after I did my mentorship. Every one of you know. And I was very happy about it. I was sitting there. I was like, okay, I'm maxed out on my lending. 1 year later, I came back to do a wealth mentor event, and I was sitting down having a coffee with my mentor. The first thing she pointed out, she was like, well, you can just double your portfolio again. Like right at this moment, you have enough equity. And at that point, I was like, really? I didn't even know that. And I went back and did my numbers, and I was like, oh, that's true. And that's how I moved on and then doubled up my portfolio again from that one conversation. So it's easier if you don't know the answer. You can have everything ready and present it to someone that kind of can see it from a bird's eye view, like what Karen said. Someone can point you in the right direction, but you need to present them with the accurate information, right? Or not just a mentor, go to the broker and say, do you think I have maxed out? Right, but you need to have accurate information to go. Right. The very, very last point is the point that I see pretty much 9 out of 10 times. Not with just any students, but with my clients and for accounting sake as well. Are you comparing apple to apple? Okay, so that is very important because, in reality, we buy properties at different stages and they have different LVRs They have different interest rates. They have different touch to every single one of them. Okay, how can you smooth out all these variances and compare them apple to apple? Because a property that is fully paid off, renting out, will definitely cash flow better than the one that has an 80% mortgage on it. Right? How can you smooth out these variances so you're looking at the fundamentals and pretty much the bones of each property, how they are performing? Okay. Are you allocating the your mortgages correctly on paper? Right? Because in the bank's eyes, obviously, oh, you've got this mortgage is tied to this particular house, this mortgage is tied to the other house. But to compare it apple to apple, you will need to do some theoretical analysis or hypothetical analysis and make sure you are comparing them on the same line. Are we following? Any questions? Make sure you type them in, okay? Because I will definitely go through them. Right. Remember our basic cash flow calculation. Okay, you need to go through line by line and see, like I mentioned, what the strengths and weaknesses of each property. Why you have that property in your portfolio. Okay, every property that you add on to your portfolio either should always strengthen your portfolio. Either it's going to, like, make up some weaknesses of the previous properties, or it's going to strengthen a little bit more. Okay, if the property is a bit more weak on cash flow because you're holding it for future potential or land developing or subdivisions or things like that, the next one you buy should be a cash flow cow. Things like that. Okay, so you need to see and analyze where your weaknesses are in your portfolio. Okay. Right. So once you have a current snapshot of your property portfolio, okay, you need to start doing some analysis or hypothetical tests to your current portfolio to see what sort of challenges you will be facing in the next short term or 12 months. Okay, so this is you being and try to think of what is coming up, what am I going to do about it? Okay, for the people that doesn't have a property, you still need to do a current snapshot. Okay, what am I earning? What are my current debts? And exactly down to the last cent, obviously, to make sure that you can present it to the broker and say, well, what can I buy? Or what should I do with the money I have on hand? Okay. I will come back to that, Nadine. I don't have a up-to-date spreadsheet. I prefer, as an accountant, everyone to do their own. Okay. I'm so sorry. The reason being is the numbers flow in a different way for different people. You understand the number differently. So my cash flow calculation will be different to you. I prefer for you to understand it bit by bit is to do that calculation yourself to make sure where that number comes from. Okay, surely, yes, we do have a lot of those template calculators and things like that. But first thing I'll say, you won't fall in love with it. You will just plug the numbers in and you won't understand it as much because you haven't done the work, you haven't built that calculator yourself. But if you put in the time, as it actually don't take that long, if you build that template yourself, trust me, you will fall in love with it and you will spend more time with it and try to understand the numbers. Yeah. So yes, I'm a very tough accountant. They come to me and say, well, I can sit down with you to do the template, but I can't give you, or I won't prefer to give you a template yourself. LVR calculation changes over time as value of the property increases. Yes, that is true, right? Okay, so you have taken out you have maxed out at 80% LVR, but as your portfolio grows in sizes 5 years down the track, you might be finding yourself sitting at a 50% LVR or 60% LVR based on your whole portfolio value. And that is what I said, you will have those sitting or lying equity sitting there not being utilized. Or you might be in a position better than you think. right? You're not at that 80% LVR. You're probably down to about the 50% LVR because of that increase in value. And one thing you can do is you can sell everything and realize the whole portfolio, right? Okay, so if you sell everything and have that $4 million cash sitting on hand, you can probably do a lot. Well, obviously, that's to the extreme, but that is one option, right, that you need to be aware of. Okay, so in terms of portfolio review and do the analysis, remember the first thing, the crucial thing is to compare apple to apple. Okay, so bring all the properties down and put it on the same line and then do these hypothetical analysis. First thing, obviously, that is always in people's mind nowadays, interest rate, right? What if interest rate go up to this number? How does it impact on my cash flow? Where is my break-even point? Okay. If the interest rate reached to, 7%, that will eat out all my cash flow. Okay, I know it. Then I need to do work. I need to make sure that I have a backup plan, or I have a cash flow plan to make sure that it doesn't go into negatively geared. If it is already negatively geared, you know you need to action immediately or do something about it. You can't just sit there and say, well, I just hope the interest rate comes down, because that is not up to us, right? So interest limitation rules. Okay, so this is a very big topic. We just have a change of government. The detailed nitty-gritties of how they will rule out or phasing back the interest limitation rules is currently unknown. Okay, so each of those parties, like Ryan has mentioned, Brendan has mentioned, have their own set of rules, but how it's going to be done hasn't been released yet. Normally they release it a few months later, and the very typical time they really love, it's a week before the financial year end date. As they know, accountants are not busy during that time. They normally try to release it. And that's how they throw us under the bus as accountants. Normally around March, okay, that is when they will release a 100 pages detailed ruling on what they would like to do. But most likely, as a lot of people anticipated, is they'll probably adopt the national rule, which is the phasing back out of the interest deductibility. So probably won't go straight away. They'll phase it back every 25% per year. So currently, this year, the 23 to 24 financial year, we're at 50% limitation. Okay, what does that mean is 50% of your interest on your rental property is not deductible for tax. Okay, so next year, what National is suggesting is stay the same, 50%. The year after, we allow you to deduct back 25% more, so 75%, and then by 2026, full reduction. So we will be still currently in the current situation for quite some time, right? Okay, so if you are currently already bleeding, you need another solution rather than relying on this rolling back of the interest limitation. Okay, so these are just the things what we need to do to plan out, right? What potential issues will we face? Okay, and also on the other side, what potential opportunities are there? Right? If you've got 300,000 of equity sitting there, you can go out and do a trade, or you can go out and do a JV in a short period of time and make use of that money, and not just sitting around and says, well, I don't think the market is the right time to buy, but I have all these money sitting, but the money's not working for you. Okay, so what can I do with this big chunk of cash that I have if I don't want to put it into property or long-term buy and hold projects? What can I do? Can I do a short-term project? Okay, can I invest it into something else? Well, I don't know, shares, bonds, whatever, or even term deposit, right? JV, angel investing, all your good options, but you need to know how much money you do have on hand. Right. At which point, very important, your portfolio will go into a negatively gearing situation. Is it because of one particular type of one property, two property, or the whole portfolio? Okay. Right. You need to work out for interest limitation rules what's the impact in dollar terms. Everyone knows, okay, yes, we are not allowed to deduct interest. It's not tax deductible. What does it mean to you specifically in dollar terms? Does everyone know how to work that out? Does everyone know how to work that out? Okay, you should know a basic calculation to work that out, right? It's basically whatever that you're not allowed to deduct times it by your tax rate, whatever entity you have it at. Okay, that's a simple calculation. Obviously, there'll be other factors, like, if you've got any losses from prior year that you can still use, or any other deductions that you can use. But in simple terms is, if you've got an interest of, let's say, 100,000, is that too big of a number for interest payments? No? Okay. Okay, let's do 10,000. I'll just put it in this group. 10,000 is your interest. Okay, so 5,000 of them will be non-deductible this year, based on 50% non-deductibility. Okay, at a tax rate of, let's say, 30%, how much tax do you need to pay based on that? How much more tax do you have to pay based on that? Okay. Everyone got the answer? $1,500? Yes? Yes? 1,500? Good. Okay, so that's 1,500 of tax payable. Okay. On very, very simple terms. Okay, you guys just need to follow on very simple terms. So that is 1,500 that needs to come out of your own pocket. And that is a big impact, okay? Because remember, at a traditional way of tax system, you only get taxed if you've got some profit or money left at the end of the day, okay? So they're only taxing you a portion of that money. But when it comes to what the current system is, you probably don't have money in your pocket because you have put that money out and paid that interest, okay? In reality, you will probably be making a loss and left with no money in your pocket to pay for taxes. This 1,500 of tax paper needs to come out from somewhere else. So it's a huge impact, right? And that's why you see a lot of investors, or it's quite a big discussion when this was first rolled out, okay? Because they are not taxing you on your pocket money. They're asking you to fork out extra money when there is no more money in your pocket. Okay, so you guys need to work out the impact of interest. Can you hear me clearly? Okay, can everyone hear me or not really? Right, I'll just try to speak a bit louder then, okay? So, in the 1,500 of tax, okay, if it's for the 2024 year, when do you need to pay? Okay, you do not need to pay until April 2025. Okay, so that is, if you use an accountant, okay, you are linked to an accountancy firm or tax agency firm, you have 1 year of extension. Okay, so all your tax or accounts are done up to 31st of March 2024. The tax bill is not due until April 2025. So as I've been said for the past year or so, this is like the boiling frog syndrome, okay? So they roll it out, people don't actually see the effect until it is too late, okay? So the gradual change, the 25%, 25% plus the deferral of tax payments might not seem huge now, right? Okay, but it will impact on you as the years to come. Okay, and that's why people don't really feel it at the first, and they were able to rule out this regulation. Okay, but by the time you know it will hurt a little bit. Okay, depending on where you are. On the other side, though, on the good side is because of this tax deferment, you actually have time to plan. Okay, so now you know you have 1,500 of tax to pay. You've got one whole year to find money for 1,500 or 1,500. Right? You can do a flip, you can do a JV to make sure, or you can work an extra hour or two to make up for this money. So you have a year to come up with this tax payment or change your investment strategies in between. So that's why you see, because of the interest limitation rules, a lot of the strategies or investment strategies have been tipped to scale. Okay, so people are considering a lot of the traditional investing they're not considering, for example, like buying new builds, doing development, social housing, emergency housing, where usually it's not that attractive, suddenly becomes a lot more attractive, right? Because of this. So you guys need to know the actual impact on your portfolio before you can assess or before you say, should I change my structure? Right, okay, once you've done your hypothetical analysis, you should have a better understanding of what do you need. Do you need more cash flow in your portfolio? Do you need equity in your portfolio? Okay, what we say that when you need cash flow is you are not getting enough money coming in, you go into negatively geared situation, you need to know whether it's short-term or long-term. Short-term, okay, you can come up with, like, you can probably ride out the wave, or, yeah, easy, right? You can have a short-term plan to ride out a wave to the market's ride or to where all these changes come back in play. You'll be fine. What if it's not? Right? What if your cash flow is fundamentally in a negatively gearing situation? Well, you need to do something differently. You might not be able to ride out a wave because this is a fundamental issue. It's a long-term thing. You need to change something in your portfolio to rectify that issue. Okay, so you need to know whether it's a short-term or long-term thing. Equity. What that means is, yes, you've got a very good portfolio of cash flow properties. Okay, you go to the bank, you find that it's harder to lend or it's harder for you to buy the next property. And they say because we can't draw down, there's no equity for you to draw down. Banks say, okay, I'm happy to lend to you, but where's your deposit? Okay, and they say we can't release any more equity from your existing portfolio. Come up with a deposit, we will lend to you. So that's what I'm saying. You need equity in your portfolio. So what can you do to increase that equity? Right? How can you come up with that big chunk of money? So we always say it's a balancing game. When you become a professional investor, it's always you adding cash flow, add equity, adding cash flow, adding equity. And not, you can't be skilled towards one side and not the other, because sooner or later you'll be stopped one way or the other by the bank or by the lenders. Okay, at which stages of life are you? Okay, is it time for you to pay down your loan and just retire and think nothing else? Or should you be like, you know, I'm only 20, 25, I'm very aggressive, I need to do a bit more investing, I need to reinvest, I go all in. Okay, so that will change your situation. Okay, obviously I'm not as aggressively investing now with a little 2-year-old compared to at that time when I say I need to be financially free by the time my little bub comes. Okay, so that's a change in situation. You need to know at what life situation you are. It's not the same for everyone, so choose a pace that is comfortable for you. Okay, but definitely you need to do something and not just sitting on your pot of cash. Right, should you sell and hold? That's been a very big question, and I like what Karen said. Like the top investors, they just it's always at a point where they will need to sell off some of the investments or restructuring their portfolio. We just don't keep all our properties and grow on them because it's very slow. Sometimes you need to sell off the not so performing properties and buy some performing properties, or you sell off someone that is not okay. The higher you go, the more the return on investment you want. You can sell off those basic investments or buy and holds and turn them into a bit more interesting ROI projects that will give you that bit of a fire. Okay, because I got a few investors sitting here. They say I'm doing the cookie cutters approach. It's getting to a point where it's not giving me excitement anymore. Well, you need to do something that's a bit more exciting. Then maybe sell two and do a bigger flip, okay? Or do a development or do whatever. They give you that bit of excitement. They give you that, okay, I'm learning something new. I'm jumping into a new environment strategy and not just repeating the same tactics again. And you say, oh, it's just another property I'm adding to my portfolio. Right? So, what options do you have? Okay, after you've done all that, okay, up until that point, we are just understanding our own situation, where we're at, where's our strength, where's our property portfolios are at. What options do we have? What ways to increase our cash flow, our current cash flow? Right? Rent review. Are you at market rent? Okay. How often do you do your rent review? Okay. Are you on top of it? We only allow one rent review per year now. Okay. 12 months. Okay. Is your manager, property manager, coming to you 2 months before the end of that 1 year and do that rent review with you and send out a letter to give the 60 days notice? So the rent review is on time every single year and not delayed for 2 months every single year. Okay, we're coming down to the nitty-gritties, guys. What can you do just to help that little bit of cash flow? Add value, right? What minor add value or things minor, when I say minor, is anything that you do without needing a consent. So it's quick, sharp turnaround time, very quick. Or in between tenants, what can you do to get that little bit of rent coming in? Okay, 3-bedroom to 4-bedroom, but not extending the house, like, just putting up a wall. Okay, compared to 3-bedroom to 4-bedroom, but extending the house, which you need a building permit. Right, adding value major. Okay, you have 20, 30 grand sitting there, you don't know what to do. What can you do to your existing portfolio? Can you do minor renovation? Can you do a sleep house? Can you do garage conversion? Can you add a cabin, extra bedrooms, extending the house, or making everything look nicer and bump up the rent by $100? Okay, what's $100 rent increase over a 20 grand? What's the ROI on a 20? If you've got 30, okay, let's say 30 grand as your cash you got on hand, you don't know what to do with it, and you put it into a renovation and you increase the rent by 100. What's your ROI on that? Everybody should know how to do the ROI calculation. Okay, 100 times 52 divided by 30 grand. That should give you a 17% return on ROI, right? A lot of my clients say, look, I've got this small chunk of cash on hand. I don't know what to do with it. Well, you can do something with it, or lend it to someone who needs to do a minor renovation and they don't have that chunk of cash, and ask for 10% return, where they're getting 17% return. But, work something out. If you don't have that asset someone else has, lend them the money. If you have the asset, you don't have the money, JV and get the money in. Right, 17 and a half or 17% on a return. Okay, what can you do to your existing portfolio? Do you need to change strategy? Okay, so this, be very, very careful. Okay, it comes down to the area, the need. You need to talk to power team, the demand. Is it suitable? Is it not? Is it growing demand? Like, Savannah mentioned yesterday, there's growing demand for rent by rooms or boarding houses in Invercargill. might not be the same in other areas, might be the other way around. So you need to see what the growing demand is for which type of property. Can you change your existing properties to fit those strategies? Rent by rooms, boarding house, Airbnb, right? Social housing, emerging housing. Okay, these are not only that can they increase the rent, but some of them are saving you costs. For example, social housing, emergency housing, you take out the property manager, right? You've got no, you don't have to pay management fees, or some people still prefer to, it's up to you. But you have no vacancy period, okay? Little things like that helps with cash flow. Rent by room, increase in rent, but you also need to take into the fact that you will have a lot more costs. Okay. Refinance. This is my favorite part. Okay. Don't underestimate the amount of how they can change the situation quite quickly with a refinance. Okay. So have a very good mortgage broker on your side helps immensely. Okay. Cashbacks. Okay, 1% cashback, just switching from one bank to the other, okay, on the same term, and they give you like 10 grand. Like, that's a no-brainer just for you to do some paperwork. How much work you can go in and do just to get that cashback, right? Changing it from P&I to an interest only. Refinance to a different bank. Brendan mentioned yesterday, it's probably harder on the same bank, but switching from one bank to the other, you get your interest only back straight away and on 30-year terms. Rather than you've been pushed into, okay, your interest only period is up, you're going into P&I. If you're not going to P&I, we do a full review on your lending and your serviceability is up for test again. Okay. Obviously, you probably get better rates, extend your loan terms. That helps with your monthly repayment rather than try to fork out the P&I every single month. Extend the long term again down to 30 years. Remember, Ryan said it's a long-term investment game, okay? It's not a short-term game. It's a long-term game that we're in here to play. Any little bit helps. Review your expenses, right? What are you paying? That is like your insurance. Can you check out whether there's another bank that's giving you promotional offers? For the rent by rooms, I'm currently investigating whether I should use solar power because I pay for the electricity and the electricity bill is killing me during winter times. Is solar power a better option? Okay, so that's something you can do or you can't do. Internet bills that I pay, like they're always I'm switching internet providers and they give you 3 months to 6 months free by signing on a particular contract. A lot of these little things you need to dig down to those nitty-gritty numbers and see what I can do as the owner to save my cost moving forward. And it all adds up, right? You put up the rent by $50, save your expenses by $50, there's $100 more in your pocket every week. Okay? Little bit counts. That comes from the accountant side. Right. After you've done that, you can now think of ways to strengthen your current portfolio. Okay, so we're down to the micros. Is that the micros? Yes, we're back to the macros. I always can't get these two words right correctly, so you know what I mean, okay? You work on the tiny little things, what you can do, and in the shortest time, okay, because these are quick changes that you can make. Now we're going to look at things that maybe take a little bit longer or need a bit more thorough planning for us to implement, is what you can do to change the direction and where you're going. For example, selling any non-performing assets. Okay, you should by now, with a thorough analysis, you should know which property. Okay, if you've got 10 properties, I know on the top of my head, if I need to sell 1 or 2, I can tell you exactly which 1 or 2 I will sell. That's me knowing my portfolio, right? Rebalancing your portfolio. Like I said, what are you missing? Are you missing equity? Are you missing cash flow? you need to add better ROI assets to the portfolio. When I say better ROI assets, it doesn't necessarily mean it has to be property. Okay, if you are having some cash flow problems, well, is there another asset that you can buy in and help to balance that weakness? Right, so if you've got a lot of people, like, you know, they still have the old stock on hand, what that means is you have bought some property that is in good areas but not quite cash performing areas, but you do not want to let them go. Well, then what other assets that you can buy that can bring you in the cash flow to help you with the negatively gearing, right? It can be another property, it can be another asset, it can be your job. You just need a way, or you just need to tell me what options you have to fund a negatively geared property rather than selling, or sell it, right? The fourth one, okay, this is a question that comes up a lot, or a situation I get asked a lot as a mentor or as an accountant. What should I do? Which projects should I prioritize? Well, you need to prioritize based on their potential. Okay, what can you do now? Do you have the funds to do now? I've got a client come back and say they have a negatively geared property on hand. They've got a land that they can develop into what, I don't know, a 10-lot subdivision. And they keep on coming back and telling me and talking about the 10-lot subdivision. I was like, hang on, okay, you don't have the funds or you don't have the expertise to do a 10-lot subdivision yet. Let's focus on turn that negatively gearing property around first. And she said, no. Okay, we can park that aside. It's more exciting to talk about the 10-lot subdivision. I was like, no. That will give you into a more negatively gearing situation. And you don't have the funds, or you don't have the ground or the fundamentals, the basics to keep you going. You won't survive in the 10-lot subdivision because, like, you know, that will put you into a more negatively geared situation for the next 2 to 3 years. You will be stressed out, right? So know what you have, know what you don't have, and make sure you prioritize on the things that you can do or improve first. Get yourself into a better situation, then tackle the bigger problem or the bigger challenges or that dream project, right? Then I will finalize with my advice is to make sure you guys for the next 12 months set realistic and actionable goals, at least 3 that you can change from tomorrow, what you can do. If you have a portfolio, what you can improve. I've given you lots of little points, the nitty-gritties, you dial into it, what you can do to improve your situation, even just by $10 a week in your portfolio, right? If you don't have any properties in your portfolio, what can you do so you can sit in front of a broker tomorrow and say, look, this is my picture, what can I buy, what money do I have? And then you can start exploring what options out there for you to start investing or start JV angel investing with some other opportunities. There's great opportunities out there, like, you know, in the properties clubs, we've got WhatsApp group. I see like these deals be flicked on every single day. Okay, you need to jump on it if it's a good deal, but do you have the ability to jump on it? Because you haven't got all your things right, or I don't even know how much money I have on hand yet. And these like good deals go quick, is what I say. Right, before I give it to Karen, I put that last line in there for Karen. Okay, can you go even more creative? Okay, I'm putting on my accountant's hat and giving you the little steps what you can do to improve. But you can go out of the picture or out of the square and do some creative deals and be different to the norm. Okay, remember, if you are just like another person out there doing property investment, then your result will be just like that normal person out there doing property investment. You must have been, for any successful investors or anyone that is got a journey or shine in property investment, everyone would have done something different, right? So what's your different point? What's your different point? Can you do something different to the norm? I'll leave it at that. Karen?